Hey guys, welcome back. In this particular video, we are going to talk about shares and its type, right? As in our previous video, we generally talk about the basics of capital market, and whenever we study the capital market, so we have number of products or instruments like shares, bond, mutual funds, debentures, derivatives. So we will cover these particular one by one, right? So here we are going to discuss shares. What is share? The basic introduction and the two major type of shares, which is equity shares and preference shares. Okay, and as you know, preference shares, which are further classified as cumulative and non-cumulative, redeemable and irredeemable, participating, non-participating, and convertible and non-convertible shares. Okay, throughout the video, we are going to talk about shares and their different types, right? So hope you guys are aware about shares. Whenever we talk about shares, it is part of ownership, right? So you can define a share as a part of ownership. Let's say there is a company or you can take an example like previously we talk about the listing process of companies in a stock exchange. Okay, it is a part of ownership or part of capital of any company. Let's say if you own 1000 shares of a TCS, so these shares are basically equity shares. Okay, and you own you have a ownership in that particular company or which is a TCS. So shares, let's say through IPO, when company registered themselves on stock exchange. So we take an example of XYZ company. So if this XYZ company, they file their IPO in the stock market. Okay, so previously this the 100% stock, they generally belongs to the stakeholders or the promoters of the company. Now with the initial public offering, they sell 10% shares to the or 10% ownership in this particular company to the investors in the form of shares. So now the new ownership type is 90 is to 10. 90% that generally owned by the stakeholders or the promoters of that particular company, and 10% shares, again this is also part of ownership. So this is owned by the general investors, which is they are generally known as shareholders in the market. So shares, a part of ownership. A shares is a percentage of ownership in a company or financial asset. Investor who hold shares in any company are known as shareholders. Okay, let's say if you buy shares of State Bank of India or ICICI Bank or Infosys, so you have certain right with this particular buying. Okay, so like if it is equity shares, so you'll get voting right. If it is preference shares, you'll get some preference during dividend distribution or during the liquidation period and all. Okay, so in simple word, shares represent ownership of a company. So now, like those who buy this 10% of shares, they become owner of that particular company. So this ownership type is indirect ownership. Okay, why it is called indirect ownership? Because like the decision making or the price determination things are remains to the stakeholders or the promoters of that particular company. Basically, if due to their decisions, if there is a profit in the market, if their company earn profit, so your share price will also goes up. And or in case of preference shares, you will get more dividends. Okay, along with this market activities. And if due to their decisions there is some loss which is or financial loss which is faced by this particular company, so your share price will goes down, and even you have to bear that particular loss in a same proportion, right? So shares, they generally give you the ownership in any company. So whenever we talk about type of shares, so we have two types of shares. One is equity, another one is preference shares. Okay, so the further categorization of shares or the types of shares, we have two. One is equity. Equity, they are generally known as ordinary shares. Okay, so let's say if you buy any company shares on stock exchange or in secondary market. Let's say you buy TCS shares from market, or you buy Infosys shares, you buy SCL shares, or any other company like Tata Motors and all. So these shares are generally ordinary shares. They are generally known as equity shares. Okay, they have a right that is called right to vote. So you can attend the AGM meetings for these particular companies. Okay, now the if you talk about the outcome of these particular shares, so that is totally depend on the market conditions. So if market condition is favorable for that particular company, so their share prices will goes up. If there is the market condition is adverse for those particular companies, they are making losses, so your share price will goes down. Another type, we have preference shares. So as the name you can see the name, or even the name state preference. So these kind of shareholders, they have certain preferences over equity shares. Okay, so basically they have two major preferences. One is at the time of dividend distribution, so their dividend is fixed. Okay, like let's say if this XYZ company, they made a profit of 100 crore in a financial year. So company, they generally there are they'll reinvest this particular money, and sometime they generally distribute a certain percentage of this particular earnings. Okay, let's say out of 100 crore rupees, 80 crore rupees they generally reinvested in the market, and remaining 20 crore they generally distributed among shareholders. So in case of preference shareholders, when you buy a preference share of any company, so that is very like that is limited to a closed group. Okay, so uh, in case of preference shareholders, so their dividend is fixed, like whatever the profit is made by that particular company, so that is pre-decide, they'll share this percentage of profit among their preference shareholders, right? But in case of equity share, it is not fixed, so it is totally depend on the company's management. They can give them a dividend, as well as they can ignore that particular one. So first, the preference is they get preference during the dividend distributions over equity shares. Another one is liquidation. Okay, so at the time of liquidation, let's say if this XYZ company facing liquidation process, liquidation means wind up. Okay, so when we do the asset distribution, or like the when company is selling it out all assets, then they are returning the money. So at that time, preference shareholders, they generally get preference over the equity shareholders, right? So preference shareholders, we have different type of preference shareholders, so we'll discuss these one as well. So as the name suggests, this type of shares give a certain preferential right as compared to other shareholders. So these right are, first one is they get first preference when it comes to the payout of dividend, right? So dividend is a share of profit earned by a company. So as I gave you an example of XYZ company, they made a profit of 100 crore rupees, and they decided they'll out of this 100 crore rupees, they'll give 20 crore rupees, they'll distribute 20 crore rupees as a dividend. Okay, so a certain percentage is prefix for these preference shareholder preference shareholders. Okay, another one is when the company wind up, preference shareholders have the right in term of getting repaid. Okay, so this is over your equity shareholders. Like whenever there is a liquidation process, first we go for the employee salary, then bank loan and all. So after all this, so if you talk about the equity and preference, so first we'll give preference to these particular shareholders. Okay, so hope this is clear to all of you. Now we'll come to the different type of preference shareholders. So basically, these preference shareholders with different rights. So we have four type of preference shareholders. Okay, so one is cumulative and non-cumulative. And cumulative and non-cumulative, it is like simple term. So let's say if you are a preference shareholders in any XYZ company, and you miss some dividend in past financial years, so in case of cumulative preference shareholders, so they'll pay out the the past dividend as well. Okay, so similarly non-cumulative, they'll not pay, so they'll pay only the financial year's dividend. Second one is redeemable and irredeemable. So redeemable, basically it is like a company. Sometimes companies issue the redeemable shares. So let's say the preference shareholders, the preference shares is for 10 years. So if it is redeemable, company can buy back within 10 years, or even they can buy back in 5 years or in 2 years as well. Okay, but in case of irredeemable, they have to hold these particular shares for 10 years. Participating and non-participating. So this is a special benefit in case of participating preference shareholders. So participating preference shareholders, they, like, let's say the percentage of dividend is 8%, but in that particular financial year, company made a huge profit. Let's say they earn 500 crore rupees in the financial year. So in case of participating, they have, apart from this 8%, they'll get some extra money from the company. But in case of non-participating, the dividend ratio is fixed. Okay. Convertible and non-convertible. Convertible preference shareholders, so this right is belongs to the shareholders of that particular company. So they can convert these particular shares in equity shares. Okay, so anytime they can convert these particular shares in into equity shares, but in case of non-convertible, they cannot convert into equity shares. Okay, so first one is cumulative. Cumulative preference shareholders give the shareholder a right to dividend that may miss in past years. So as we earlier take an example, okay, let's say there is a dividend for financial year 2021, and the shareholders, they generally miss that particular one, so company will give it in the current financial year. Okay, so they are entitled to those before the holder of a common shares can receive dividends once one more time. Okay, redeemable. If you talk about redeemable, so redeemable preference shareholders are those preference shares that can be bought back by the issuing company. Okay, so let's say any company who issue preference shares for 10 years, but this is a redeemable type. So they can buy back in 7 years or in 5 years as well. So they do have that right. And vice versa, irredeemable. So they cannot buy till the maturity. Next one is participating. So this is quite interesting. So apart from that fixed dividend, if companies making huge profit from their market, so they'll get some extra. Okay, so participating preference stock or shares, a type of preferred stock that give the holder the right to receive dividend equal to the whatever we made in the agreements, specified rate or the ratio preferred, and as well as an additional dividend based on some predetermined condition. Okay, let's say if company will earn 100 crore rupees in a financial year, so your dividend ratio will be 8%. And if company earn more than 100 crore rupees to 200 crore, so your dividend will be 10%. More than 200 crore to 500 crore, your dividend will be 15%. So this kind of benefit, which are generally part of your participating preference shareholders. But in case of non-participating, it is simple. Like whatever profit is made by company, so your dividend ratio is like that is predetermined. Okay, so it can be 8%, it can be 7%, 5%, whatever is decided by the management of that particular company. Okay, so hope this is clear. Convertible and non-convertible. So whenever we talk about convertible, so those preference shares which can be converted into equity shares. Okay, let's say if you buy if any investor or any institution who have XYZ companies preference shares, okay, and these are convertible in nature, so they can convert this one into equity shares. So there is no lock-in, so they can convert these particular shares or same amount shares into equity shares, and then they can sell equity and they can liquid their money. Okay, so convertible preference shares, those shares that can be converted into equity shares, and non-convertible, they cannot convert it into common stock, so you have to hold these particular shares until the maturity period of that particular preference shares. Okay, so guys, these were the preference shares and the different type of preference shares and the basic about the preference shares. And these are very important for examination viewpoint. So many time examiner they generally ask question based on the different type of the preference shares. Now next one is equity shares or the ordinary shares. Equity shares are like let's say if you planning, these are available for the common person. Okay, let's say if you are planning to invest in Indian share market, if you want to buy shares of SBI or any other Indian company, right? So you'll buy the equity shares or the ordinary shares. So equity shares, they also known as ordinary shares. The majority of shares issued by company are equity shares. If you'll see the company account 1 and 2 of any company, so you'll find the majority shares are generally equity shares, because preference shares they are generally offered to the close group of investments. These are most of time financial institutions or HNIs customers and all, right? But for the common person we have equity shares. If you'll see the overall issuing ratio, so you'll find there is more equity shares in the market for the diversification purpose, right? So this type of shares is traded actively in the secondary market or stock market. These shareholders have a voting right in the company's meeting. Okay, so let's say if you own 10,000 shares in any XYZ company or TCS, so whenever they conduct their AGM, so which is annual general meeting, so you have a right, you can attend that particular AGM, so and you can vote on the common issues. Okay, so many time in examiner they generally ask question based on like which type of shares have the voting right. So your answer will be equity shares, and they do not, there is no commitment from company you will make this percentage of a profit if you buy these kind of shares. That is totally depend on the market condition. So if market condition means or market factors means demand and supply, if there is a high demand for that particular company, so their prices will goes up. And if there is a supply, which means that particular company is making losses in past few months or few years, so the prices of that particular company will goes down. Okay, so there is no commitment of dividend or other fixed rate of interest and all. Okay, so equity shares, these are ordinary shares in nature, and they have a voting right. So the investor they can participate in the board meetings. Board meetings means AGM only, annual general meeting. Okay, so guys, in this particular video we generally talk about shares and the different types of shares. So many times you will find a question based on this particular topic. So if you study the capital market, we have number of instruments in capital market, so we will cover these particular instruments one by one. So in this video we generally talk about the shares. Now next video we'll talk about mutual funds, and we have derivatives, we have bonds. So there are so many products, we'll discuss one by one. So hope you like the video. If you like, please do share with your friends, and if you are new to our channel, please do subscribe. So thank you for watching this video guys. Bye bye, take care.